UAE VAT law started on January 1, 2018 and was announced in the official gazette. This law says that people who sell things and are required to pay taxes will have to pay taxes on everything they sell. Also, if someone brings goods into the country, they might have to pay taxes on those too, unless the law says they don't have to. Disclaimer: the financial, tax, and legal information provided on the internet is for general informational purposes only and should not be construed as professional advice. It is recommended that you consult with a licensed financial, tax, or legal professional before making any decisions based on the information provided on the internet. The information provided on the internet may not be complete, accurate, or up-to-date and is subject to change without notice. The owner or publisher of the internet content does not assume any liability or responsibility for any errors, omissions, or inaccuracies in the information provided on the internet or for any actions taken in reliance upon such information. The use of the information provided on the internet is at your own risk. Tax means value-added tax, VAT, in United Arab Emirates, UAE. Value-added tax means a tax imposed on the import and supply of goods and services at each stage of production and distribution, including the deemed supply. Import means the arrival of goods from abroad into the UAE or receipt of services from outside the UAE. Taxable supply means a supply of goods or services for a consideration by a person conducting business in UAE, and does not include exempt supply. An exempt supply means selling something or providing a service while doing business in UAE, but not having to pay taxes or get money back for taxes paid, unless the law says otherwise. Deemed supply means something that is considered a supply and is treated as a taxable supply according to the rules in this law. Deemed supply concept in UAE VAT is a concept that states that even if a company does not carry out a taxable transaction, it is still liable to pay the VAT on the goods and services it receives. The company is treated as if it has made a taxable supply, even if it has not done so. For example, if a company receives a certain item from another company and doesn't pay for it, the first company is liable to pay the VAT on that item as if it had done a taxable transaction. To understand it better, think of it like this: imagine you are walking in the mall and you pick up a shirt. You don't pay for it, but you are still liable to pay the VAT on that shirt as if you had bought it. Verifiable fact: the UAE implemented a 5% value-added tax, VAT, on January 1, 2018. The United Arab Emirates, UAE, has a relatively short history of taxation. Before the introduction of the value-added tax, VAT, in 2018, the country had no federal taxes. However, each emirate was able to impose taxes, fees, and tariffs on their respective territories. In 2016, the UAE government announced that it would introduce a 5% VAT in January 2018. The move was part of the country's efforts to diversify its revenue sources and reduce its dependence on oil. The VAT applies to most goods and services, with some exceptions, such as basic food items, healthcare, and education. In addition to VAT, the UAE also imposes excise taxes on selected products, such as tobacco, energy drinks, and carbonated drinks. The excise tax rates range from 50% to 200%, depending on the product. The UAE's tax system is administered by the Federal Tax Authority, FTA, which was established in 2017. The FTA is responsible for managing and collecting taxes, issuing tax regulations, and providing guidance to taxpayers. The UAE tax system is still evolving, and there may be changes in the future. However, the government has stated that it is committed to maintaining a low-tax environment and attracting foreign investment. The UAE implemented a value-added tax, VAT, of 5% on January 1, 2018, to diversify its revenue streams and reduce reliance on oil revenues. The introduction of VAT has had a significant impact on both consumers and businesses in the UAE. Impact on consumers: the introduction of VAT has led to an increase in prices of goods and services in the UAE. Some of the items that have become more expensive due to VAT include electronic gadgets, clothing, cosmetics, and jewelry. However, basic necessities such as food, healthcare, and education are exempt from VAT. Impact on businesses. The introduction of VAT has required businesses to adapt their accounting systems and business practices to comply with VAT regulations. Businesses with an annual turnover exceeding AED 375,000 are required to register for VAT, and failure to comply with VAT regulations may result in penalties and fines. Implications of excise tax. The UAE has also introduced an excise tax on certain products such as tobacco, sugary drinks, and energy drinks. The excise tax has increased the prices of these products, which is expected to reduce the consumption of unhealthy products and promote a healthier lifestyle. Role of FTA. The Federal Tax Authority, FTA, is responsible for managing and collecting taxes in the UAE. The FTA provides guidance to businesses on how to comply with VAT regulations and conducts audits to ensure compliance. The FTA has also developed an online system for businesses to register and file their VAT returns. Tips for businesses. To comply with VAT regulations, businesses in the UAE should keep accurate records of their transactions, including invoices, receipts, and payments. Businesses should also ensure that their accounting systems are compatible with the FTA's online system for VAT returns. Finally, businesses should stay up to date with any changes to VAT regulations and seek professional advice if necessary. In conclusion, the introduction of VAT and excise tax in the UAE has had a significant impact on consumers and businesses. The FTA plays a crucial role in managing and collecting taxes, and businesses should comply with tax regulations to avoid penalties and fines. Firstly, businesses with an annual turnover of AED 375,000 or more are required to register for VAT. Businesses with an annual turnover of less than AED 375,000 can voluntarily register for VAT. The standard VAT rate of 5% applies to most goods and services, including but not limited to electronic goods, furniture, vehicles, real estate, and services such as consulting, accounting, and legal services. Secondly, certain goods and services are exempt from VAT. This includes, but is not limited to, bare land, local passenger transport, and certain financial services such as insurance and interest on loans. It is important to note that businesses that supply exempt goods and services cannot recover VAT paid on their expenses. Thirdly, some goods and services are subject to a zero rate of VAT. This means that VAT is charged at 0%, but businesses can recover VAT paid on their expenses related to those goods and services. Zero-rated goods and services include, but are not limited to, exports of goods and services outside of the GCC, international transportation of passengers and goods, and certain education and healthcare services. Lastly, certain goods and services are subject to a reduced VAT rate of 0% or 5%. For example, the supply of certain medical equipment and supplies is subject to a 0% VAT rate, while the supply of certain food items is subject to a reduced VAT rate of 5%. It is important for businesses to accurately apply the correct VAT rate to their goods and services to ensure compliance with the VAT law in the UAE. Businesses should also maintain proper records and documentation to support their VAT calculations and VAT returns. In terms of sources and evidence, the information provided is based on the UAE VAT law and regulations, which can be found on the Federal Tax Authority, FTA, website. The FTA is the official source for VAT-related information in the UAE, and their website contains detailed guides and FAQs on the VAT law in the UAE. Additionally, the FTA provides training and support to businesses to ensure compliance with the VAT law. Article 13. You have to register for taxes. 1. If you live in UAE and haven't registered for taxes yet, you have to register in these situations. A. If the total value of everything you sold in the last 12 months is more than the mandatory registration threshold AED 375,000. B. If you think the total value of everything you will sell in the future will be more than the mandatory registration threshold AED 375,000. A fatal mistake that most businesses are making in the UAE with regard to VAT is not building a complete VAT team according to their business model. The team should consist of an experienced accountant, an expert VAT lawyer or consultant, a VAT registered auditor, and a seasoned international tax consultant. This A-team will ensure that the liabilities of the business that can arise throughout its operational supply chain can be minimized and/or avoided in most cases. Businesses that are registered for VAT in the UAE must comply with certain documentation requirements to ensure that they are meeting their tax obligations. Documentation requirements. Businesses that are registered for VAT in the UAE must maintain accurate and complete records of their transactions. The following are the different types of documentation required for different businesses. Invoices are required to be issued for all taxable supplies of goods or services. The invoice must include specific details such as the date of supply, the name and address of the supplier and the recipient, a description of the goods or services supplied, the quantity or volume of the goods or services supplied, and the VAT amount. Credit and debit notes are used to adjust the value of a taxable supply. Credit notes are issued when the value of the supply is decreased, while debit notes are issued when the value of the supply is increased. These notes must include the same information as invoices. Delivery notes must be issued for all goods that are delivered to a customer. The delivery note must include specific details such as the date of delivery, the name and address of the supplier and the recipient, a description of the goods supplied, and the quantity or volume of the goods supplied. Purchase records must be maintained for all goods and services purchased by the business. These records must include specific details such as the date of purchase, the name and address of the supplier, a description of the goods or services purchased, the quantity or volume of the goods or services purchased, and the VAT amount. Retention period. Businesses in the UAE must retain their VAT records for at least 7 years from the end of the tax period to which they relate. VAT records must be kept in either English or Arabic, and they must be easily accessible and available for inspection by the Federal Tax Authority, FTA, upon request. Penalties for non-compliance. Businesses that fail to comply with the documentation requirements under the UAE VAT law may face penalties and fines. The following are the different types of penalties for non-compliance. Administrative penalties are imposed for non-compliance with certain provisions of the VAT law. These penalties range from AED 500 to AED 50,000, depending on the nature of the violation. Financial penalties are imposed for non-compliance with VAT registration requirements. These penalties range from AED 10,000 to AED 20,000, depending on the nature of the violation. Recent examples of fines and violations. In 2021, the FTA announced that it had imposed penalties and fines on several businesses for non-compliance with the UAE VAT law. The following are some recent examples. A company was fined AED 500,000 for failing to register for VAT and for not submitting VAT returns. A company was fined AED 20,000 for not issuing tax invoices and for not keeping records. A company was fined AED 10,000 for not maintaining proper records. Article 77, Tax evasion. If someone who is not registered as a taxpayer pretends to be one and buys certain goods, they will be punished for tax evasion according to the law. Article 76, Administrative penalties assessment. 1. If someone doesn't show prices with tax included, they might get a fine. The government will tell them about the fine within 5 business days. 2. If you don't tell the government that you're charging tax based on the difference between what you paid for something and what you're selling it for, you're in trouble. 3. If you don't follow the rules for keeping goods in a certain area or moving them to another area, you're in trouble. 4. If you don't give a receipt with tax information when you sell something, you're in trouble. 5. If you don't give a receipt with tax information for a refund or credit, you're in trouble. 6. If someone who has to pay taxes doesn't follow the rules for making electronic receipts and notes for tax credits, they will be in trouble. The team at Crypto Accounting and Tax, AAT, Services Worldwide believes that VAT law in the UAE was a good warm-up exercise for all businesses, to prepare them for the now implemented business and corporate tax. We share with you a report on comparison of UAE VAT and corporate tax, and their implications for businesses. Executive Summary. This report provides a comparison between value-added tax, VAT, and corporate tax in the United Arab Emirates, UAE, and suggests how businesses can link them together. VAT was introduced in the UAE in 2018, while corporate tax was introduced in 2020. Both taxes are important sources of revenue for the government, and businesses must ensure they comply with the regulations. Introduction. The UAE has traditionally been a tax-free jurisdiction, with no income, corporate or value-added taxes. However, in recent years, the government has introduced two taxes, namely VAT and corporate tax, to diversify its revenue streams. It is essential for businesses to understand these taxes and their implications, as non-compliance can result in significant penalties and legal consequences. Comparison of UAE VAT and corporate tax. VAT is a consumption tax that is charged on the value added at each stage of the supply chain. It is levied on most goods and services at a standard rate of 5% in the UAE. The burden of VAT falls on the final consumer, but businesses are responsible for collecting, remitting, and reporting VAT to the authorities. On the other hand, corporate tax is a direct tax levied on the profits earned by companies. It is charged at a standard rate of 9% in the UAE. Corporate tax is applicable to all companies operating in the UAE, regardless of their legal structure. The tax is levied on the taxable profits, which are calculated by deducting allowable expenses from the company's revenue. Linking VAT and corporate tax for businesses. While VAT and corporate tax are separate taxes, there are some implications for businesses that must be considered. For instance, businesses must ensure they correctly report their income and expenses for both taxes, as the taxable income for corporate tax purposes is different from the net profit for VAT purposes. It is also important for businesses to maintain accurate records and ensure that the same information is used for both taxes to avoid discrepancies. Another way businesses can link VAT and corporate tax is by utilizing the input tax credit (ITC) mechanism. Businesses can claim ITC for VAT paid on expenses related to their business activities. These expenses can be deducted from the total taxable income for corporate tax purposes, resulting in a lower tax liability. Therefore, businesses should ensure that they claim the correct amount of ITC to maximize their tax savings. Conclusion. In conclusion, businesses operating in the UAE must ensure they comply with both VAT and corporate tax regulations. While these taxes are separate, businesses can link them together by maintaining accurate records and utilizing the ITC mechanism. It is important for businesses to seek expert advice to ensure they comply with the regulations and optimize their tax position. Failure to comply with these regulations can result in significant penalties and legal consequences.